Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Now, is property investing dead after the federal budget? That's the question a lot of investors are asking, and given the changes to negative gearing and capital gains tax, it's understandable. But in this episode of Geared for Growth, I sit down with Simon Pressley to get past the budget night noise and back to the fundamentals. And Simon's view is pretty clear. The rules have changed, but the need for housing has not. People will always need somewhere to live. Shelter is about as fundamental as it gets, and Australia still has a growing population, tight rental markets, and a chronic shortage of suitable homes. But Simon also makes an important point that often gets lost in these debates. Demand is not just population growth. Demand is people with money, borrowing capacity, confidence, and a reason to buy. And supply is not just how many new homes get built. Supply is also the number of suitable properties that are actually listed for sale. So while the budget may change the tax treatment of established property and push more investor capital toward new builds, the underlying drivers of property markets still matter. Jobs matter, income growth matters, confidence matters, local economies matters, stock on market matters, and good assets still matter. We also talk about the cash flow reality for investors. Under the new rules, some losses may not disappear, but they may be carried forward rather than helping with cash flow each year. That makes holding property harder for some investors, especially newer investors who relied on negative gearing in the early years to help carry those losses. But Simon's broader message is not to throw the toys out of the cot. If you can afford to invest and you want to build a better financial future, you still need to make intelligent long-term decisions. The budget changed the rules. It did not change the fundamentals. Let's get into it. Simon Pressley, thanks for joining me back on Geared for Growth.
G'day, Mike. Thank you for having us back, and hello, listeners.
Now, look, I must apologise that as at the time of recording, this is the morning after budget, and I wanted to talk to you about a blog that you wrote about jobs and how that influences property markets. But look, honestly, I know you don't watch budgets and you call this noise, but we're going to get hate mail if I don't ask you questions about, well, what does it actually mean for investors? Like, are we now... Is the playing field now so different that investment fundamentals have been shaken up like a Coke bottle?
I guess it's an obvious question, but the honest truth, the answer is no. Do I like it? No. Was I surprised by the Chainsaw Chalmers policy announcements? No. But has it happened before? I don't think there's ever been a year in Australian history, Mike, when there hasn't been not just one, but lots of challenges that the nation's confronted, especially challenges to do with housing. But at the end of the day, housing will never go out of fashion, my friend. Humans will always want to live in homes, and there's never been a single year in the 230-year history of this country when we've built more than what we need. So nothing will change there. Hopefully, our listeners and broader Australian society are intelligent enough to understand that the federal budget has one primary goal in mind, and that's that the bastards are reckless spenders. They spend every cent they already had, and they spend every other cent they didn't have, and now they need to find some more money. It's they use the Australian taxpayers' money, Mike, a bit like a sports bet account. They are addicted, like cocaine, to spending other people's money, and they've already proven that they make reckless decisions with it. Frankly, we should be taking hard-earned tax money away from them. We should be reducing taxes because how they spend it is fucking deplorable, frankly. But yet they're taking more. So this has got nothing to do with the marketing. Chalmers' marketing is that I'm doing this, I know we're broken promises, but, we're doing it because we're going to improve housing affordability, we're going to improve housing supply, we're going to improve rentability, whatever. But we can all see that this is just a revenue grab. How does it affect property markets? I've got every reason to believe that the next 20 years, and progress is never linear, but the next 20 years, the value of a standard Australian home will be worth at least 3 times what it is today. Now, how can I say that with such confidence? Because the previous 5 blocks of 20 years, so 100 years, each of those 5 blocks of 20 years, there has never been a 20-year block where the median house price has not grown at least triple. The smallest, if you can call it small, the smallest out of the 5 blocks of 20 years is house prices increasing by 3.6 times. There's been a couple of blocks of 20 years where Australian property values went up 5 times. There's no reason to believe, as I said, housing will never go out of fashion. We'll always need it. We've got the most capitalised banks on the planet, so credit will always be readily available. We've got the most responsible, the most prudent credit policy. So we're never going to have a jingle mail, GFC problem in Australia with recklessly approving loans. We're never going to build enough homes. So name something that's more resilient, more reliable, more dependable to invest in as an asset class than housing. There is nothing. But do we like what Chalmers did last night? No, but suck it up. Bad things happen all the time, right? Refocus. Investing is a discretionary action. It's not a law. I encourage everybody to get out of the weeds, stop consuming media, get away from the water cooler discussions, because none of it will help you to just confuse your mind or make you angry, and bring it all back, strip it all back and go, what do I want my future to look like? When I'm age 60, when I'm age 65, when I'm age 70, what do I want to be doing? And what's required for me to do that? It's financial resources is the answer, right? That's the goal. That's why people invest. It's not about being a landlord. It's not about taxes or anything like that. It's about making enough intelligent decisions during the time that you're in the workforce so that later in life, you have the flexibility and the resources to exit the workforce. So throwing the toys out of the cot and ranting and raving like I'm probably doing a bit now isn't going to change what Chalmers did last night. So you can't control that. You can't reverse that. But you can control what you do next. If you can afford to invest, you need to invest.
You're ranting if you are ranting, you're ranting on the other side of equation. You're not ranting at the change, and I'm sure you have your own views about how ridiculous it is. I mean, we've already shared some of that. But at the end of the day, politicians are pretty famous for tinkering, making ridiculous decisions with unintended consequences that we all just have to deal with.
Yep.
And what can we do? We can rant and rave, but at the end of the day, we go to the polls and we can make our decision that way. So if we think about fundamentals for housing in Australia, one thing I wanted to pick up that you said is we've never built enough, right?
Yeah.
And the demand for housing is increasing. We have an increasing population, both naturally and with immigration. The demand for houses outstrips our ability to build them. And we've thrown the kitchen sink. I mean, at least the government has tried to throw the kitchen sink at it. The 1.2 million homes over 5 years, we're about to hit year 3. We're about 30% behind that target. And there's an argument to say with immigration that wasn't enough anyway. Is that the simplest way for people to think about it, is that houses will continue to grow in value if we don't build them as fast as demand requires them?
No, it's not as simple as that. I'm not saying the statement you made there, Mike, is not true. It is, but a property market's as simple as that. No. People don't understand demand and they don't understand supply. And we've had discussions before, backed up by evidence, that demand is not fucking population growth. It's not. It's a human using money to buy something, whether it's food, whether it's fashion, whether it's cars, whether it's property. Demand exists when a human hands over the money and purchases something. When it comes to homes, yes, we might only need one home to live in, but we buy multiple homes or multiple properties, most people, throughout the course of their life, because households change, circumstances change. The person who's single has a different housing need to the person who's a couple, to the one that's got a young family, to the one that's in their 50s with a much higher income when they become a first home buyer and a lot of equity and they want to upgrade to something nicer, right? So it's volume of transactions, that's demand. Prices for anything goes up when the relationship between what's available and active purchases, when there's pressure.
Yeah.
And the underlying thing for pressure is jobs. I know you want to ask me some questions about jobs.
Yes.
On the supply side of things, the same that people don't understand demand, they don't understand supply. They think the supply is all about the actions of the construction sector. It's not. It never has been. I'm not saying that building homes is not important, but that's more the responsibility of the authorities, Albo and the state governments, and to a lesser degree the local councils. But in terms of, if we're talking, this conversation is about property market performance and change in asset values. The volume of new construction, whilst it has some influence on property market performance, in the overall scheme of things, is very, very little. Because at the end of the day, buyers determine what they buy. Albo can throw whatever bloody dart he wants at the board, whether he says 1.2 million homes over 5 years, whether he says 20 million homes, or whether he says 2,000. It doesn't matter. At the end of the day, governments, federal, state and local, between them, this is a fact, between them in any year, they fund no more than 3,000 homes per annum. Right? So what's 3,000 times 5 years? If my maths are good, mate, that's 1,500. Right? Yes. And he's got a target of 1.2 million, right? So at the end of the day, it's not governments, it's the private sector, it's property developers and the construction sector. They determine what gets built. The role and responsibility of governments is to make the regulatory process as efficient as possible. Have the government thrown the kitchen sink at that? Shit, no. Have they made it easier for the construction sector to get a building approval application approved? No, it's slower. Have we had practice at building homes before? Oh, only 237 years. You reckon we'd know how to do it by now, right? But does it take quicker or longer once they do get that piece of paper and says we can approve? We've got this approval, can we go ahead? Does it take them a longer period of time or a shorter period of time? With all this bloody technology and 237 years of practice, it takes longer to build, right? But at the end of the day, in terms of market performance, the most important metric on the supply side of things is the volume of properties listed for sale. A buyer can't buy anything if it's not available.
Yes.
Albo or the property developers or whoever, it doesn't greatly matter how many new ones are available. The buyer determines what they buy. Whether there's a lot of new ones available or not many at all, you and I and everybody else, we determine what suits our needs, not a government or not the construction sector. And buyers have a lot other more important things higher on the list of priority than the age of the dwelling.
Yeah.
I would suggest it's probably in more this order than, is it new or is it used? It's more, firstly, what can I afford? And for some people, that will eliminate a lot of properties, new or used, because they just can't afford it. And then it's more, where do I want to live? So if they decide that we want to live close to the city or a middle ring suburb or something like that, well, they've got no interest in buying something like way out in the outskirts of the city that they're living in, right? So those new ones aren't even going to be considered if it doesn't suit where they want to live. The size of the dwelling, the style of the dwelling. So we've in the last 20 years, for some stupid reason in this country, for every 10 new homes that get built, five of them are apartments. And state and federal governments of all persuasions would say, well, that's responsible because that's all part of the affordability equation. Apartments are more affordable than houses. Well, that bit's true, but they're not fit for purpose. Most people, owner-occupiers, most of them, if they don't already have kids, they are buying their first home in anticipation that at some stage soon they will. So the apartment's not fit for purpose. You can't even fit a bloody dining room table in most apartments, that more than two people can sit around. So they can't invite friends around. They've got no room for storage. They've got no connection to nature. So dwelling style and number of rooms and having a yard for the kids and the dog and all those sort of things, they're all part of a buyer's selection criteria. So if the number of properties listed for sale, regardless of what's built, if that volume is really low, then they'll all sell. There'll be some buyers who'll miss out because there's not enough available. And the buyers who are successful in purchasing something will have to compete harder for it. That puts upward pressure on asset values. Right here, right now, regardless of what Chalmers said yesterday, Australia's population is 2.3 million more than this time 6 years ago. And what's available for buyers to consider purchasing today, Mike, is 27% less than 6 years ago when we had 2.3 million less people sitting here. So Chalmers can do what he wants, mate. But asset values, I'm not saying every city's the same, but there's intense pressure on property prices. Before we started this recording, for the listeners, we not only are facts and figures people, we buy all over Australia. We are active right now in umpteen markets in umpteen states across Australia, and property markets are running at double-digit rates of growth in large parts of Australia, but not in Sydney, not in Melbourne, and not in Canberra. So that's why the national media headlines in the last few months refers to, flat market, softened market. I've even heard, bloody hell, Crimea River. I've even heard seeing the term downturn being used. I'm going, really? You're using that word when most of Australia is growing that between 10 and 20% because there's bugger all stock. Long answer to your question about supply.
No, that's great. And it begs the question, well, what is likely to happen to stock? Because, we talked about, the perhaps over-exaggerated notion that supply is just new dwellings, but supply is listings, right?
Yes, listings.
We've seen a bit of an uptick in listings, but we're below the 5-year average.
Well, even that statement's not true. You've had a bit of an uptick in a couple of cities.
Yeah, well, true.
But again, but people, it's good that you make the point though, because the fact that you make it, most of the 28 million people living in Australia will come to the same assumption that you have, because excuse the French, but the shit they're reading, that's what it's saying, right? But that's looking at Australia as a whole. Data. It is, which is useless because you don't buy the Australian property index. You've got to pick a particular location, don't you?
Yes, yeah. So if we put that one to the side, and I completely agree with you, like the problem I think that we have in general is we talk about the market, and that's what leads to statements like national property downturn, because you only need the two big cities to be floundering around, and it is a national downturn in terms of overall median, but but you can have 20% growth in heaps and heaps of markets at the same time and still technically be in a downturn. But why are stock levels tight, and should we expect to see any change in that over time?
Yes, it's a great question, and there is no defined answer to that. I've been looking for an answer to that for a long time, because we're now into the 7th year that the volume of properties listed for sale across Australia has been at a record low. Again, I'm not saying that every city is the same, but if we bundled up, all markets, it's been at a record low. So that's a long period of time. It was trending in that direction before COVID, and then when COVID hit, it dived much deeper, and it's pretty much stayed at that drought level for ever since. I think stamp duty has a lot to do with it. A buyer can't buy something. And again, 95% of buyers do not buy new, they buy used. Because of the list criteria and the priorities we're talking about earlier, they buy used, right? But if it's not for sale, they can't buy it. So for someone to, a buyer, whether it's an investor, an owner, a first-time buyer, an existing owner-occupier, it doesn't really matter. If they have a particular criteria that they are trying to meet as a buyer of property, the odds are that property that they're looking for is owned by a Mike or a Simon or someone else. It's an established dwelling. But they can't buy it if the existing owner of it doesn't have it for sale. So that existing owner, a big deterrent for them, and I refer to this as just broader human mobility, is stamp duty.
Yep.
Right? Which,
a mobility tax, I think
correct.
You called it before.
And who's responsible for that? Governments. Right? And how often do we hear every bloody day governments say, we care about. But all their actions are the complete opposite. They are the ones who create the problems. Stamp duty is the single biggest deterrent for human mobility. And mobility is important for every adult Australian, no matter what age they are, because we move all the time as our lifestyles change. Now, whether we move from one corner of a suburb to the opposite corner of a suburb, or whether we move city or whether we move state, we still move, and you need people to be able to move to explore goals, chase careers, and retire or relocate or whatever. Like, human movement is critical. So stamp duty is that grit in the cog, if you like, Mike, and I think it is the biggest contributing factor to the low volumes of properties for sale.
Well, it's the biggest contributing factor to a lack of mobility, but it's the biggest contributing factor to tax revenue at the state level, at least in a majority of states, I would guess, right? So are they going to change anything
Never.
that influences their tax income? I mean, you've been saying for years that the states are drunk on property tax.
Yeah. Well, all governments are. All levels of government are, right? And last night's budget was just the latest episode in... government houses are institution for idiots, Mike. Politicians are plonkers. They are the worst representation of the human race. They, if we describe leadership, I would say characteristics would include honesty. Governments tell lies all the bloody time. Financial responsibility. They are the most reckless spenders on the planet. Efficiency. Everything that they touch takes 10 times as long as what it should. Leadership is visionary. They're not visionary. They've got no vision, no goals, no dreams, no nothing. They're suppressants. So they're not leaders. They're not the lucky country that Australia rightly earned for generations. They've stuffed that up. They don't care about that. They care about being popular to enough hands, so that when it's voting time, they get re-elected. So to them, it's being a politician is more like trying to win a premiership for a sporting club, as opposed to doing the best you can for the constituents that you represent. But stamp duty, my friend, is now more than $40 billion per year. That's what our state governments get. $40 billion. Is that a lot of money? That's for 1 year. Well, a world-class hospital, I would suggest that's a pretty important piece of infrastructure. And show me a year ever when someone has said that, we don't actually need to invest in hospitals. But a world-class hospital costs about $1 billion. So these crackheads, they make $40 billion every single year just from clipping a ticket when someone buys a property. They don't do anything for stamp duty. They just clip the ticket.
Yeah, I want to see the stamp. Like, it must be gold-plated. It's a ridiculous idea. So I want to ask the question of you, and we'll get to jobs after this, and I'm sorry to put you through this, Simon, but there'll be people at home going, okay, well, what does this mean for me as a property investor? Well, we know with the CGT, it means that you're going to be paying a minimum rate of 30%, whereas the maximum, or the minimum rate before was 23.5% on the highest margin rate. So if you make $1 million in property over 30 years, instead of paying $235,000 back, you pay $300,000 back. And you're like, oh, okay, well, that's still profit. That's still money. It still makes sense. One of the big impediments is that I presume that in climates like this, and most of the time, people are leveraged to the point of, let's just say it's an 80, 90% LVR. The property is going to be negatively geared, and you need to be able to cover that shortfall. And negative gearing, obviously, is an instant cashback in that financial year, whereas now it's going to be tacked on the end as an offset on the gains in future. Do you think that hurdle of people being able to stomach that $200, $300, $400 a week, which is not tax deductible now, will mean a decrease in investor population? Should people be worried about that? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Should you be worried about that? No. But will some people do what you described? Absolutely. Humans can are so capable, they can put the man on the moon, mate, but they make so many deplorable decisions every single day, including the inability to control their own emotions and make practical, rational, intelligent decisions, including what will happen here. So there'll be some investors who, or either existing investors or some who are contemplating investing sometime soon, who will behave a bit more like the spoilt child. I want my lollies and you haven't given my lollies, and they'll throw the toys out of the cots at tantrum throwers, right? There'll be some people who do that. okay, if that's how you got to deal with your own emotions, do it. But if you allow that attitude to carry on for more than a few weeks, you're only harming yourself, right? Because I'll repeat something I said earlier. Investing is a discretionary action. No one has to do it. But the smart few who do it, which isn't many, the smart few who do it are wise enough to realize that I need to make 3, 4, 5 really intelligent decisions during the 45 years that I'm in the workforce so that I can extract myself from the workforce and enjoy the lifestyle for the remaining 30 years of my life, right? That's what we need to do. So you need to do that now. You need to do that last year before the federal budget. You need to do it next year, no matter what changes come next year. You need to always have that attitude. So there will be some chance controllers. Hopefully for them, they slap themselves around the face and sort their emotions out sooner rather than later. And because the longer they delay, when they eventually get their emotions sorted, they'll realise that markets have still grown. And when they get in, they'll pay more than what they could have. So that's issue number one. There will be others, though, who are more adversely affected, not so much in an emotional sense, but Chalmers' change means they literally can't afford the purchase because they were reliant on being able to claim the annual loss as a tax deduction each year. And that's a shame for them. But I would say to those people, don't be defeated. If you physically can't afford to invest in your future now because of Chalmers' decision, then you can't, right? But you owe it to yourself to remain focused on your future goals and revisit your game plan and work out, well, what can I control? And when can I do that? I can't do it now because that's a decision, but you will be able to do it sooner or later. And the sooner you can do it, the better for you. So people who, if we wound the clock back just a week before the federal budget, right? The person who's preparing to invest, before they do that, they've got to get their finance sorted. Banks assess that loan that's got nothing to do with negative gearing benefits. They look at what income do you earn that we regard as reliable income, including any future rental income, and what existing financial expenses do you have? What tax obligations do you have? What living costs do you need? Is there a surplus? Yes or no? If there's a surplus, the loan gets approved. So nothing's changed there with serviceability. In practice, if the person who took that loan out, got it approved, then purchased the property, round figures today, if they bought a stereotypical 800 grand property as an investment today, and it was 100% leveraged, a majority of property investors purchase without using cash, quite wisely. They typically have a non-deductible home loan. So if they've got cash, they deliberately leave the cash in the offset account, offsetting the non-deductible interest on their family home, and they use equity in the existing asset to raise the deposit on that investment property they're about to purchase. So I'm not saying it's the only way or everyone does it, but it's the most common way. And for that existing owner-occupier, it's the smartest way, right? So let's deal with that first, because that's the highest inputs of cash flow. 100% loan-to-value ratio on an $800,000 asset in Australia somewhere today, before you lodge your tax return, will have a net loss of about 25 grand per annum. So that's taking in 48 weeks per year rent, your interest on your loan, your council rates, your repairs and maintenance, etc., right? There'll be about a 25 grand shortfall. Last week, before the budget, you would then lodge your tax return and you'd get about 1/3 of that 25 grand loss back under the negative gearing scheme, right? So 25 grand loss becomes whatever, 17 grand, something like that. Now, the figures aren't changed. It's still a 25 grand per year shortfall, but you have to absorb that. Whereas before you had to absorb after tax deductions the 7 or 8 grand. But as you rightly said, it's not like that shortfall's gone. It will accumulate, and whenever down the track you go eventually sell that property in 20 or 30 years' time, you'll add up all those annual losses, and that will be factored into the way capital gains tax gets calculated back then. So if you can afford the 25 grand loss per year, invest. If you can't afford it now, you need to control the controllables until you do have a big enough income, or you cut your own discretionary expenses, or both. But when you can afford, when you can afford to invest, if you don't afford to invest, you're only harming your future self.
That's a good point. So if we title this episode for the clickbait, is property investing in Australia now dead post-budget? You're speaker 1, 2 and 3 for the negative, and I think you've made a pretty compelling argument. So
it'll never be dead, mate, because I promise you this, humans will always live in houses. It'll never go out of fashion. And there'll never, ever be anything on the planet that's more resilient, more reliable, more safer than investing in, other than this glass of water. The most essential thing on the planet is housing. That's what we're investing in. That's never going to go out of fashion.
Even gold bullion is not in Maslow's hierarchy of needs, is it? But shelter is, right? So that's what we're talking about. So there'll be a lot of noise and people's heads will be rattling for weeks, if not months, about this. And then we'll see the drafts and the devil will be in the detail and Liberals will try and form some credible opposition. There's a lot of crap that's going to happen that you're not going to be personally distracted by, and your leadership will ensure that anyone in your sphere of influence will not be distracted by that either. So now we get back to fundamentals, and the whole purpose why I reached out is after reading your blog about jobs. How jobs influence property prices. Now, of course, it makes sense that if you are living in a location where you have an opportunity to increase your wage because there's more investment from local companies, there's more opportunities, there's a diversification of employers, there's just more opportunities, that of course, means that you've got a recipe for more income to be able to employ in ways that fit your lifestyle, which is maybe expanding from a home, from an apartment to a house because you want to have kids, or upgrading. In your research, how would you describe jobs and job opportunities and their influence on the property market?
Again, demand is a human using money to purchase something. When the relationship between what they want to purchase and what's available, when that's pressured, the value of that something goes up. But when we're talking about property, that philosophical statement hasn't changed. The only thing that's different between property and, say, food or fashion or something like that is it costs a lot more. So the transaction for it to take place, for roughly 7 out of every 10 properties that are purchased, for the transaction to take place, the debt must first be purchased. We don't think of it that way because the sexy bit's not the debt, the sexy bit's the asset. But in practical terms, that's what a human does, right? Whether they're buying as a first home buyer, whether they've got an existing home and they're upgrading to something bigger to support a young family, or whether they're upgrading to something nicer because they've got a higher income, or whether they're investing. It doesn't matter the individual purpose of the buying. It's the volume of buyers competing that forces upward pressure on property. The reason jobs are so important to property market performance is that liability piece. No one likes the debt, but we know we need it to purchase the asset. No one applies for the debt without having confidence in their ability to repay it. So it's not just job creation. It's not just as simple as City A has got more jobs than someone else. It's not as simple as that. But a community. I mean, Mike's reaction or Simon's reaction doesn't influence a market. It's the actions of the big critical mass that determines market performance. And this is why economic performance for Propertyology, it's all about that individual city. I don't give a stuff about the national economy or the state economy because you can't invest in the nation or the state. You've got to invest in the city. So it's the performance of the individual city that directly influences confidence of the residents living in the city and what I refer to as strength of their income. So you can have someone who might already have a job, but if they're living and working in a city that has an underwhelming economy, they personally might not necessarily feel that their job is safe. If they feel that way, even though that ideally want to become a first home buyer, or they ideally want to buy the bigger home or the nicer home or invest in their future, if they don't have the confidence in the strength of their job, they won't go into debt.
You don't go debt shopping if you think your ability to buy that debt service that debt is on the decline.
Correct. Yeah. So that's that. So I've described the scenario of someone who does have a job, but it's a big critical mass of the city that they're living in having more jobs, which gives each person in that city confidence that my job is safer now than what it was, 5 years ago when this city's economy wasn't great. It also benefits the person who 2 years ago might have had a job, but it was part-time or it's casual. And as that individual city's economy improves, it goes from part-time or casual to being full-time. So now that person is capable of considering the same things I said earlier. Yes, I will become the first-time buyer. Yes, I will invest. Yes, I will upgrade. Job growth also increases the potential for someone to relocate from City A to City B to take up the new employment opportunity in that thriving economy. So it's all those things combined that why jobs are the precursor for property market performance. Now, let me give a current day tangible example of what I'm talking about. It also highlights what's not important, and the big bad world puts unreasonable amount of weight on. Let's talk about Australia's second largest city. Its population growth over the last 8 years was 650,000 people. No city in Australia has had anywhere near that rate of population growth in the last 8 years. Melbourne's had that. For perspective, 650,000 people, population growth in 8 years, is effectively building Canberra 1.5 times, the national capital, right? 650,000 people in just 8 years. In the same 8 years, Melbourne's median house prices increased by a miserable 10%. There are more than 100 individual towns and cities, that in the same 8 years, the value of a standard home has increased by 100% or more. And none of them have had remotely close to that amount of population growth. In the same state as Melbourne, a regional city, it's about Australia's 43rd largest township from memory, Mildura. In that same 8 years, its population increased by just 400 people in 8 years. And Mildura's median house price increased by 105% compared to Melbourne's 10%. It's not about big city.
This population thing.
Is Melbourne a beautiful city? Yes, I went there 6 times last year. Beauty has nothing to do with property market performance. It's a subjective thing. Is Melbourne a big city? Yes. Does big have something to do with safety? No. Nothing. Capital city, does that have something to do with performance or safety? No. Relevance to Sydney, does it have anything to do with performance? No. Population growth, does it have much to do with property market performance? A little bit, but in the overall scheme of things, stuff all. It probably ranks about 20th on my list of priorities. Why was Melbourne? Who picked on Melbourne? No one picked on Melbourne. The economy for much of that 8 years has been very disappointing. Melbourne residents don't have anywhere near the confidence that they had before. Job creation in Melbourne, most of it, and I've got the facts and figures here, most of it is in not in the private sector, it's in the public sector. So there have been manufactured jobs. There's been governments using taxpayer money to just make up a reason to create a job. So when someone looks at an unemployment rate, they go, oh, yeah, Melbourne's still going okay. But you've created a job to do what? To move a paperclip, right? To shuffle something. It's not actually creating something, but it's one of many things that's added to the enormous debt that the Victorian state government have. $200 billion now, right? So when you make years and years and years of bad decisions about the economy, now that state government doesn't have the financial resources to invest in infrastructure, to provide opportunities and encouragement for all the different industries to invest in businesses in the city. Instead of encouraging businesses to invest, they're taxing businesses more. So that deters businesses from creating jobs and encourages someone to move away from a city, not to move to a city. So it's never been about the size of a city, capital city or region. It's never been about population growth. It's about the quality of decisions and how they influence economic performance. That is the secret sauce of property markets.
And sticking with the comparison between those two cities, Melbourne and Mildura, what has happened different in Mildura that has led to that degree of confidence where people are happy to transact and the jobs are more real than public sector. I think actually now in terms of OECD countries, we are right up there in terms of percentage of public servants in the country. But, it's a Labor government, so it makes sense.
As is often the case, Mike, it's never one thing. It's a series of things, and it didn't happen in one day or 1 year. It's a series of things that happened over a period of time. But Melbourne has a greater dependency, I suppose, on revenue from the state government for its workforce and for investing in infrastructure, which is really essential for, say, the construction sector. Whereas, every region or every capital still has a degree of dependence on state and federal governments for revenue. But a big city like Melbourne has proven to be more reliant on that. And when economies are generally managed well, that reliance can be supported. The resources are there. But if there's years and years and years of poor decisions, then eventually the resources get depleted. So that's where it's at now. So Mildura, whilst I'm sure it would love the Victorian state government to give it some more money to invest in Mildura infrastructure projects or something like that, it's not relying on it as much as what Melbourne has. Mildura and Melbourne are both cities of substance, but they've got very, very different economic profiles. So Melbourne is more, it was, back in the day, it was hardcore manufacturing. Australia doesn't make much anymore, mate. We don't even make a paperclip or a computer or anything, right? So Melbourne doesn't have that, but it is and probably always will be a white collar, economic profile. Whereas Mildura, it's a combination of agribusiness. It's a very, very productive provider of all sorts of foods. So that's not just at the farm, but there's all sorts of factories that process things, whether it's turning the grapes into wine or, turning the fruit into something in a can or in a packet, or the lamb or the beef or whatever. So agribusiness is not just farming, because there's actually not many people who work in the farming, but in food manufacturing, it's there. Mildura has become a popular place for tourism. We all like different types of holidays. It's not all about everyone wanting to go to a resort or go fishing on the beach. We all like different types of things. So those who like the food and booze, type of holiday is popular for that. So there's been a lot of things that have happened there. They've been hosting a number of events. It's not a capital city, but it does host a number of cultural events throughout the year. So it just keeps the cash registers, ticking a lot longer. And during COVID as well, there are literally hundreds of parts of regional Australia that people have sort of transferred their job from a big concrete jungle because they've got this innate need now to be living somewhere that anchors themselves closer to natural environments. So your Melbourne, Sydney, Canberra, I'm not saying everyone's the same, but they don't want that anymore. There was a time in their life when they did want that.
Yep.
And being locked up for so long, it's like, bugger that, I'm not going there anymore. Bought the T-shirt, don't like it. So Mildura is one of hundreds of options for people who want the regional relocation.
So if we're closing today and people have listened to this and they're like, gosh, this guy's making sense, but they're still paralyzed with a little bit of fear, because we tend to overemphasize the near-term stimulus and underemphasize the broader view. Like, what would your advice to them be?
Focus on facts. Most people, indirectly or directly, mean well. But when it comes to understanding property markets, this will probably won't surprise you, it'll surprise your listeners. There are only, other than myself, there are only two people in this country whose opinion I give a rat's ass about. No one understands it, Mike. Right? No one understands it. Their reputation proves that they don't understand it. So why am I saying that in answer to your question? Be wary of what you're reading is why I'm saying it.
Yeah.
The author and the people quoted in what you're reading overwhelmingly probably mean well, but the quality of what they've said and what you've read and how you then allow that to influence your mood, your actions, your decisions is not helpful to you. So put the fucking device down and get back to facts and logic and clarity. Now, if you want that for property markets, let me give you some of those facts, because it's not about Chalmers. Chalmers is on a mission to raise revenue through extra taxes. These are federal government RBA statistics. When we look at the total value of all Australian homes, and we subtract the total value of all home loans, Australia as a whole has a loan-to-value ratio of just 30%. We have oodles and oodles and oodles of equity, right? There'll be plenty of people listening to this that will think about that and go, well, how's my household looking compared to that? Oh, you know what? My house today is worth a lot more than what it was 5, 6, 10 years ago. And yeah, I've still got that debt, but geez, I do have a lot of equity there. There'll be investors that'll be doing the same, right? So that's one really key thing. You're safe. I mentioned another statistic earlier. The volume of properties listed for sale today is 27% lower than 6 years ago, and we had 2.3 million less people. Supply is tight, and there's nothing that Chalmers can do that all of a sudden is going to make millions of homes fall out of the bloody sky. They've failed at that for the last 200 years, and certainly there was nothing announced on Tuesday, the 12th of May, that's going to change that. The rental market, the number of properties listed for sale today for tenants to rent is 48% lower than 6 years ago, again, when we had 2.3 million less people. I mentioned equity, deposits. This is an RBA statistic. So deposits is basically a collection of all, cash accounts, term deposits, offset accounts. We have households, this is not businesses, households, $1.9 trillion in cash.
Yeah, wow.
We need no one's permission to spend that. People listening to that, I encourage you to think about your own cash situation, because most of you have probably forgotten you've been really responsible with your money, and you've got however many thousands of dollars sitting in your offset account. You're safe. They're strong fundamentals. Home loan arrears. How many times do we hear the term mortgage cliff and distressed sales? Oh, right?
Yeah.
Officially, again, Reserve Bank statistics. Australia's home loan arrears rate is 0.7%. We're not even at 1%. And it's been that low right throughout the rising of interest rates. But what do you read about interest rates in the media each day? Doom and gloom and fear and fucking scaremongering. Home loan repayments. Most owner-occupiers know that they've got a non-deductible debt, and we've all got a minimum monthly repayment the bank sets for us, but most people are responsible and say, well, I've been given a 30-year loan term, but ideally I want to pay it off quicker than that. And they've been doing that since whenever they took the home loan out, right? So just about everybody with a home loan are well in advance of the minimum required payments. So the RBA official statistics, we've got $14.9 trillion in surplus home loan repayments. You can claw that back if you're in trouble. That figure is 5.8 billion more than 6 years ago. So, mate, we're safe. We've got 1.6 million more jobs now than 6 years ago. The economy broadly is solid. We've got 215,000 jobs advertised in Australia this morning. Businesses who have a job, but they don't have someone with the skilled labour to fill it. So there's nothing to be dooming and glooming about. Get out of the weeds. Ask yourself, where do I want to be 10, 15, 20 years' time? And focus on what you can control to do that. The taxes are the taxes. But what you do will determine where you end up. If you've got a better asset that you can think of to invest in property, explore it. But most people, when they go through their options, they'll realise there's a reason for someone hundreds of years ago who phrased the term safe as houses.
Mate, what an absolute belter of a way to finish. Thank you very much for being patient with me, trying to drag you into the weeds to talk about what's going on there, but giving us all that sense of perspective that the real story is well above the weeds in a helicopter view of individual markets rather than the market. It's always a pleasure, mate. Thanks for coming on.
My pleasure. Anytime, Mike. Take care, mate.
Cheers.